The money in your account does not move because you told it to. It moves because the system allowed it. That difference is easy to miss when everything works normally. The payment goes through. The transfer completes. It feels like control. But beneath that routine lies a quiet structure most people never see. Every transaction is a request. And every request is evaluated by systems you do not control. Consider a moment almost everyone has experienced. A card that worked yesterday suddenly declines. A transfer that normally takes seconds suddenly sits in review. An account that functioned normally in the morning becomes restricted by the afternoon. The balance has not changed, but something else has. The system has decided this is not a malfunction. It is a structural feature of modern financial systems. Access to money is not determined by possession. It is determined by permission. That permission exists within an architecture built to manage risk, enforce regulation, and maintain stability across a vast network. Banks, payment processors, and regulatory authorities all participate in that architecture. Most of the time, the system quietly says yes. But the authority to say no is always present. Understanding why requires examining how modern banking actually works. A bank account appears simple. You deposit funds. The balance increases. The account functions like a digital wallet storing your money. But legally and structurally, the arrangement is different. When funds are deposited, the depositor transfers ownership to the institution. The bank records a liability. The account balance represents the bank's promise to repay the depositor on demand. The money becomes part of the bank's resources. This distinction matters because claims operate within systems and rules. Those rules govern how banks manage liquidity and comply with regulations. Under normal conditions, the rules are invisible. Transactions move through automated processes that verify identity and ensure compliance. If everything aligns, the system approves it. But approval is not automatic in principle. It is conditional. The system evaluates the request before allowing it. This evaluation occurs in milliseconds. A card payment triggers a rapid exchange of information between several institutions. The network forwards that request to the issuing bank. The bank checks balance, reviews risk signals, and determines regulatory criteria. If everything appears normal, the system responds with approval. If something appears unusual, the system declines the transaction. The account holder does not participate in that decision. The system makes it. The same principle governs digital transfers. Although the process appears direct, it passes through clearing networks and intermediary institutions. The authority to allow or deny the transaction belongs to the institutions operating the infrastructure. Financial institutions are required by law to monitor financial flows to prevent fraud, money laundering, and illegal activity. Algorithms analyze patterns. Compliance databases screen identities against sanctions lists. Risk models detect unusual behavior. Most of the time, these systems operate quietly. They allow transactions to proceed. But when triggers appear, the system intervenes. A transfer may be paused, a payment may be declined. An account may be frozen while activity is reviewed. From the perspective of regulators, these interventions protect the system. From the perspective of the individual holder, they reveal a deeper reality. The system decides. The account holder participates in the system but does not control it. This asymmetry is clear in risk management. Banks operate where stability is critical. A loss of confidence can trigger a run on deposits, potentially destabilizing the entire system. To prevent this, banks must constantly manage liquidity. Liquidity is the ability to meet withdrawal demands. Banks maintain liquid assets to ensure transactions process even during stress. But this requires control over financial flows. If large volumes move rapidly, institutions may slow transactions. This demonstrates that access to money depends on institutional judgment. The system determines when normal activity continues and when intervention becomes necessary. This principle extends beyond individual banks. Modern financial systems rely on interconnected networks across multiple institutions. Clearinghouses ensure that payments between banks settle correctly. International payment networks route transfers across borders. Regulatory authorities oversee financial flows to enforce laws and prevent systemic risk. These networks function smoothly most of the time, but they retain the ability to intervene when needed. If a transfer triggers compliance concerns, it may be halted for review. If an account appears connected to prohibited activity, it may be frozen. The balance may remain unchanged, but the ability to move the money disappears. This structure reveals an important distinction between ownership and access. People often assume owning money means having unconditional control. Within the banking system, that assumption does not fully apply. Deposits are claims within a regulated infrastructure. Access to those claims depends on the rules governing that infrastructure. Those rules exist for reasons beyond the interests of any individual. Financial systems must prevent crime and manage risk across millions of transactions. Achieving these goals requires oversight. Authority includes the ability to intervene. Over time, technological advances have expanded this authority significantly. Modern institutions analyze enormous volumes of data in real time. Machine learning systems detect patterns that indicate fraud. These systems enable rapid responses to potential threats. They also reinforce the system's ability to control financial activity. The more digital financial infrastructure becomes, the more centralized the control of financial flows becomes. Decades ago, physical cash provided a parallel form of money. Cash transactions did not require approval from digital networks. Today, cash plays a much smaller role. Most payments occur electronically through bank accounts and digital platforms. Electronic payments require infrastructure. Infrastructure requires governance. Governance requires decision-making authority. The system decides. This authority does not always appear dramatic. Often it appears in small interruptions that seem routine. A payment flagged for review, a transfer requiring verification. These events are usually resolved quickly, but they expose the structure behind everyday financial activity. The account holder does not possess absolute control. The stability of the system outweighs the autonomy of individual participants. When stability and autonomy align, transactions proceed without friction. When they diverge, the system intervenes. This intervention may appear sudden to the account holder. Monitoring systems continuously evaluate financial activity for signs of risk. When they detect anomalies, they trigger responses. The purpose is not necessarily punishment. The purpose is control. Control allows the system to respond to potential threats. Institutions operate the infrastructure. Individuals rely on it. This asymmetry becomes more significant as systems become digital. Digital infrastructure concentrates authority within institutions that design payment networks and banking platforms. Salaries are paid through bank accounts. Bills are settled electronically. To function economically is to operate within the system. And within that system, the authority to decide remains centralized. Most of the time, the system exercises that authority invisibly. Every transaction passes through systems capable of approving or denying it. The authority remains embedded within the architecture. When intervention occurs, it arrives quietly. A transaction declined, a transfer delayed. The balance remains visible. The account holder believed they controlled the money. But control belonged to the infrastructure. The system does not merely process transactions. It evaluates them. It decides whether they should happen at all. The system decides. And that moment is when people begin to understand how modern financial systems actually work.